Welcome to the deep dive. Today we are getting into the story of Capture a Trip, an experiential travel company from Shark Tank India Season 5.
And our mission today is to sort of untangle this really fascinating contradiction.
Exactly. On one hand, you have this massive digital community, but on the other, you have some really serious operational debt.
So we're going to figure out why the Sharks decided to take a bet, but at a much, much lower price.
Because you have to know the headline number right up front, and it's a real jaw-dropper.
Oh, yeah.
The founders walked in asking for 75 lakh rupees for just 1.5% equity.
Which, if you do the math, values the company at 50 crore rupees.
50 crore, that's about 6 million US dollars. I mean, that is an unbelievably aggressive ask for a company at their stage.
And, spoiler alert, they did not get it. Not even close.
Yeah.
They were really forced into a much lower valuation.
It just shows this huge disconnect between how they saw their company and, well, the financial reality of it.
It's the perfect Shark Tank story, isn't it? You know, this huge ambition just smacks right into a very harsh financial wall.
But the ambition, you have to say, it kind of makes sense when you look at the sector.
It absolutely does.
No?
Capture a Trip is sitting right in the middle of this surging experience economy. It's huge right now, especially with young Indian travelers.
We're seeing this whole generational shift, right?
Completely. Gen Z, millennials, they're prioritizing memories and experiences over, just buying stuff. So the market is definitely there.
And the founder's personal story was so key to selling that vision.
Nitin Khanna.
Yeah, he had this very serious corporate background in ITHCL, Tech Mahindra, and then he takes this trek to Kutla that just changes everything.
And he told that story so well. Our sources pointed out his style was humble, but also really humorous.
Which is where that famous line came from, where the Sharks called him not a green flag, but like in a good way.
It built that immediate connection. For a travel brand, that's everything.
Okay, so let's unpack what they actually do. Capture a Trip is based in Delhi, and they're not just selling holidays.
No, they're curating these community-led group journeys, everything from like Himalayan treks to big international trips.
They're less of a tour operator and more of a social orchestrator.
That's a great way to put it. They are hyper-focused on what we're calling the solo but social segment.
And the data on that is really clear. Their customers are young.
Overwhelmingly. 53.5% are millennials, and almost 30%, 29.7%, are Gen Z. These are first-time adventurers, often traveling alone.
Which brings us to their big, unique selling point, this community-first idea. It's basically a strategy to reduce risk.
It's all about humanizing travel, because the biggest hurdle for this demographic, especially for solo women, is the fear factor.
And solo women make up, what was it, almost half their customer base?
Almost 50%. That figure alone is proof that their model is solving a real, deeply felt problem in the market.
They're essentially selling trust.
Exactly. And for trips to these offbeat Indian places, like Tosh or Speedy Valley, that trust is priceless.
Speaking of their trips, let's talk about the pricing, because this is where it gets a little complicated.
Right.
Your average domestic package is pretty affordable, around 6,500 rupees. But then there are international trips.
Those are at the high end. 2 lakh, 2.5 lakh rupees sometimes.
So that explains their average order value, their AOV. It's a surprisingly high 83,000 rupees.
Yeah, that big number tells us that even with all the affordable domestic trips, a good chunk of their revenue is coming from upselling their community to those really high-margin international tours.
Which makes you wonder, are the Sharks investing in the community, or are they investing in the high margins?
That is the central tension of the entire pitch. And to see how the Sharks navigated that, we have to look at their metrics.
Which are, frankly, a total contradiction.
They are. On one hand, you have this incredible digital traction. They've served over 50,000 travelers.
And their social media footprint is huge, over 541,000 followers.
But the real magic isn't the follower count. It's the tech underneath it.
The Next.js platform.
Right. It gives them phenomenal SEO performance. The data we have shows they pull in a massive 82,882 organic visitors every single month.
That is the company's crown jewel. Think about it. It's basically a zero-cost customer acquisition funnel.
A huge advantage. Their competitors are burning cash on Meta ads, on Google ads for every click. Capture a Trip is just dominating keywords like safe solo female travel India.
So, it sounds like a dream business. Zero cost acquisition, huge community, massive market. Why on earth did the valuation get slashed from 50 crore to 15?
Because now we have to talk about the dark side, the financials.
And this is where it all starts to unravel.
It does. So despite bringing in about 3 crore rupees in revenue per month, the company has, well, catastrophic financial problems.
They're carrying 90 lakh in debt.
And that's not even the worst part. Their operational burn rate is a staggering 2.10 crore rupees per month.
Wait, hold on. They bring in 3 crore, but they're burning 2.1 crore just to run the business.
Correct. So their actual cash flow is only about 90 lakh. And that's before they even start paying back that debt.
That is a razor-thin margin. It screams financial instability. No wonder the sharks balked at the 50 crore valuation.
It's a massive red flag.
Why?
But the counter argument, and the reason they got a deal at all, was the sheer size of the market. India's experiential travel market is projected to hit $45 billion by 2027.
So if sharks weren't investing in the current P&L, they were investing in the potential of that market and their proven ability to capture it online.
Exactly. Which sets the stage for a really brutal negotiation in the tank.
So let's go into the room. You have Kunal Bahl, Mohit Yadav, Aman Gupta, Anupam Mittal, and Namita Thapar on the panel.
And as soon as those financial numbers came out, you could just feel the mood shift.
The exits came pretty fast. Namita Thapar was first.
Yeah, she just said she couldn't see how it could scale to the size she looks for in an investment. Pretty straightforward.
Anupam Mittal was next. He didn't like the business model itself.
Right. He felt the low-cost, service-heavy combination just wasn't a compelling structure for him.
But the sharpest critique, I think, came from Aman Gupta.
Oh, absolutely. He zeroed in on the biggest risks. Not just the regulatory stuff, which is always an issue, but something much more dangerous for a brand like this.
The risk of con.
Exactly. A scandal, a safety issue, one bad incident on a trip could destroy their entire brand overnight.
Especially when your whole identity is built on trust and safety for solo women.
Precisely. He also pointed out their cap table was a mess, which would scare off investors down the line.
So with 3 sharks out, why did Kunal Bahl and Mohit Yadav stay in? What did they see?
They saw the macro trend. They saw those 50,000 travelers, that 500,000 strong community, not as a risk, but as a proven sales pipeline.
They were betting they could fix the finances with the right guidance.
They were betting on the founders and the market.
Which brings us to the negotiation. They started at 75 lakh for 1.5%. 50 crore valuation.
And the sharks came back incredibly hard. Their first counter was 75 lakh for 7.5%.
A 10 crore valuation, they cut it by 80% right off the bat.
It was a classic down round, forcing the founders to face that reality. Your great SEO can't just erase your debt and your burn rate.
But the founders didn't just fold, they negotiated.
They did. They held their ground and they met in the middle.
The final deal, 75 lakh rupees for 5% equity, with Kunal Bahl and Mohit Yadav.
Which puts the final valuation at 15 crore. Still a huge drop from their 50 crore ask, but they walked out with a deal.
Okay, so they have the money. Now the big question, how do you turn a 15 crore company with all this debt into a 100 crore business? What's the roadmap?
Well, the market trends are definitely on their side. The Indian travel sector is set to contribute over $250 billion to the GDP in 2026.
And they're perfectly positioned for the mountain trend, right? 92% of Indians want more mountain adventures. That's their specialty.
That's their sweet spot. Plus, outbound tourism is growing at over 14% CAGR, so their international trips have a tailwind too.
So step 1, year 1, must be fixing the finances.
Financial triage, exactly. That 75 lakh is going straight to debt restructuring, stabilizing the books, and hitting EBITDA neutrality. They have to stop the bleeding first.
And what about that canned factor, the safety risk that Aman brought up?
That's priority number 2. They're rolling out a gold standard safety audit for every single trip leader, every partner hotel. Plus, comprehensive travel insurance is now standard in every package.
That's defense. What about offense? How do they grow?
It's a 2-pronged attack. More international routes for the high-margin customers, and going deeper into those offbeat domestic locations where their community gives them an edge.
But the real key to long-term success is the tech, isn't it?
It has to be. In year 2, the plan is to launch a proprietary Capture a Trip app.
And what does that do?
It's the lock-in. It'll manage group chats, photo sharing, itineraries. It becomes the central nervous system for every trip.
So it creates what they're calling the community flywheel.
Yes. You travel with them, you use the app, you connect with people on the app, and then you book your next trip through the app. It creates a closed loop, and boosts that customer lifetime value.
So they're moving from just booking trips to owning the whole social experience around the trip?
That's the idea. And the big vision for year 3 is to license that entire model, the safety protocols, the app, everything, to partners in, say, Southeast Asia or Europe,
So they become a global brand.
from a travel agency to a global lifestyle community.
And if they pull all of this off, fix the finances, scale internationally, and get a solid 10% repeat customer rate, what's the end goal?
The target is a 100 core plus valuation by 2028. That's the bet Kunal and Mohit made.
So there you have it, the full story. Capture a Trip used their massive online community as leverage to get a deal, even with all that debt.
Our synthesis really shows that in this travel sector, digital mastery and community can give you incredible leverage. That zero-cost customer acquisition was their lifeline.
But that investment is entirely conditional on them fixing the finances and, most importantly, nailing those safety protocols.
They have to prevent that con risk at all costs.
Which brings us to our final thought for you to chew on. We know that 86% of Indians now use some form of AI for trip planning. Capture a Trip's plan is to use all the data they collect for hyper-personalization, suggesting the perfect trip for you based on your past behavior.
So the real question for their future isn't just can they sell more group packages, it's can they use that data and AI to truly own the future of solo, social, and above all else, safe travel.